panel and this terrific group of people to talk about impact investing. And with this session, we wanted to really get out of the clouds and into the weeds. I mean, there's lots of impact investing sessions, and anybody who's been tracking this goes to them and they'll tell you how it's so great and it's so wonderful and this is what it does and this is how big the market is. But it's hard to figure out how do you do it. And we've got some people on this panel who've really been involved with putting deals together, whether as board members or as managers or as investors, and can really talk about what is it to do an impact deal? What does it mean? What do you have to think about? So without further ado, I'm just going to introduce the panelists by name. All of their bios are in your books. Starting over here, we have Dave Chen, who's the CEO of Equilibrium Capital Group, and really one of the sort of smartest and best involved people on impact investing. I mean, really knows this field and knows how to get it bigger. En Lee, who's the director of the Impact Investment Exchange Asia, and can give us some great insights in terms of what's going on with impact investing in that part of the world. Sari Miller, who's the CEO of Sarjay Inc., and who is an investor and has been very involved in a number of different impact investments, most notably are Leapfrog Investments, the microinsurance company that works in Africa. And Eitan Stibbe, who's a founding partner of Vital Capital Fund, which is a private equity fund that invests in Africa. And they all come at this from a slightly different angle, but we've had some good conversations on the phone, and we want to carry them over to you. So with that, can we put up slide number 1, please? We have this because, again, what is impact investing? I mean, different people use it in different ways. You see foundations use it, you see investors use it, you see people who are looking for above market returns, below market returns. So we've thought, for the purposes of this panel, an impact investment is any investment which includes impact as an intentional part of the investment thesis. So it's kind of, you know it when you see it, but it's people who really do want to have impact and see that as some part of their investment. The returns can be just simply return of capital, or it can be shooting for the moon, whatever. It can be in any asset class, and it can be in any sector. And it can be whether in emerging markets or developed markets. So that sort of says it can be anything, and in some ways it can, but the critical point is that first one, which is having some element of impact. So I'm going to let each of our panelists very briefly tell you, in that context, what makes them an impact investor. So Dave, why don't I start with you?
Well, thank you. I'm Dave Chen and Equilibrium Capital Group. Equilibrium anchors one very specific end of the impact space, and that is our fundamental belief is that sustainability and impact is rooted in market inefficiency and in growth opportunities. So inefficiency and growth. So we see sustainability as an economic shift, an economic driver. And if you put all three of those together, we think that there's a alpha opportunity, and we call it sustainable alpha. And that you can, with intentionality and permanence and additionality, create investment strategies that, in fact, tap into those inefficiencies that others don't see, into growth opportunities, and generate at least market rates of return. Our strategy is to focus in on the real assets categories. So facilities, energy, water, real estate, land, real assets. We saw it 5 years ago when we founded this firm as really 2 or 3 attributes why we focused on real assets in the impact space. And that is that huge categories, massive opportunities for tapping into inefficiencies, massive opportunities for direct impact. If you change the land, you're changing the environment, you're changing the community. And lastly, we saw it as a grossly underserved asset class. And so very few institutional fund managers were doing strategies in real assets and in sustainability. And so that's what we do, sustainable real assets.
Terrific. And
fantastic. Good morning, everyone. Very good to be here today. Still a little bit jet lagged from a 20-hour flight, but hopefully can share some insights from Asia. I'm a director at a company in Singapore known as Impact Investment Exchange. Bit of a mouthful, so we bridge ourselves as IIX. So I head the investor team at IIX, and what IIX really focuses on is facilitating impact investments into Asia Pacific. So we generally cover 15 countries in Asia, 7 impact sectors, anything from healthcare, inclusive finance, education, clean technology, renewable energy, affordable housing, etc. And essentially what I do in my job is I spend my time working with about 230 accredited investors globally. They include high net worth individuals, family offices, funds, and institutions. And what we do is we do a combination of a bit of a matchmaking. So what that means is we work very closely with investors to identify that many of you that are here today are into impact investing because you typically have a sector of interest or a philanthropic motive. So we usually start, at least from the investor team, by doing that. We have a corresponding team that focuses on looking at the opportunities and trying to find a match. So we're a little bit like a social investment bank in some ways. Then we facilitate the match and we make the deal happen. I'll share some of the interesting structures and transactions experience that we see on the ground. But glad to be here today.
Sari?
It was in 2006 when I began to sell my portfolio since the prices really made no sense. For me, this was the beginning of thinking about a new way to invest and to be more catalytic and sustainable. I was eager to reconceive my goals and to focus on something that's called profit with purpose. Companies spoke about corporate social responsibility, CSR, and some incorporated it into their plans, but it really never became integral. But in fact, it was very good for public relations. A Harvard professor, Michael Porter, Mark Kramer, and others began to speak about shared values. It was to create economic value by creating a better community. It's to connect the company's successes with that of the communities and to make the values embedded into the strategy. It's about authentic collaboration, innovation, productivity, transformation, and sustainability. And it all has to be measurable, both the social and financial returns. Impact investments require a lot more due diligence than other transactions. It's not just about getting the deal done. It's about the goodness factor. And I spend a lot of time engaged in that. Will the goodness factor underpin the company's culture? Are the shared values part of its DNA? Do I feel a relationship based on mutual respect, trust, transparency, passion with little compromise on values? Leapfrog, the world's first microinsurance fund, was launched at the Clinton Global Initiative in 2008, the same month that Lehman went bust. We raised $135 million, and we had a plan to help 25 million poor, vulnerable people in the world. Leapfrog was my first impact investment, and I was there from inception. All these deals entail intensive involvement to bringing concept to fruition. Some of the other angel impact investments that I've been involved in include Grassroots Business Fund, Nexi, where capital meets impact, and Purpose, a company that builds social movements deploying the collective power of millions of people to purposeful action for good.
Great, and we'll get into a little more detail about some of those as we get into it. Hey, Ton? What
Thank
makes
you
an
very
impact
much. I couldn't
investor?
say better than explain impact investing better than Sari.
So what makes you
Yeah.
an impact investor?
Maybe I'll jump into an example, a practical example, and analyze it from that aspect. Housing is a very important sector for developing countries, specifically for Africa. Any country needs housing. It's labor intensive. It improves the environment, living environment. It's an important sector. Now you can look at this sector as a real estate, construction business, or look at it as we do in Vital as building communities. It means before doing any construction work or investments, we study the market, we meet the people in the remote areas, we meet the government to see the priorities, and build a project based on the culture, the local culture, the needs, and all other aspects of the society. In order for that to succeed, it's not only to build buildings, but it's to look after all the government systems, utilities, infrastructures, water, electricity, sewage control, and actually bring along the government to join us in our investment. So we will, if we invest in a African country, we'll come to the government and present our criteria and our standards and ask them to join us in the investment.
Great. So are these deals riskier? Dave, what are your thoughts on that? It sounds too good to be true that you can, go out there and make some money and try and save the world at the same time.
In some ways, I would actually say that if we take our cues from some of the our friends in the pension world, like Ontario teachers that have been going through a pretty methodic process over the last few years of looking at the risk in their complete portfolios across their assets from climate change, for example. I would actually make the counter argument that if you're not thinking about these sustainability trends, about the issues of global demographics, about the consumption of natural resources, about the market opportunities within the emerging countries and in poverty, you're actually incurring greater risk in your portfolio because these are things that are going to be visible and apparent economically over the course of the next decade. Mm-hmm. All right? So in some ways, we look at many of our investment asset managers as future-proofing their assets. So for example, our green real estate portfolio manager, GED, when we started with that 5 years ago, a lot of the CIOs would look at this and ask the question, is this economically based? I don't believe in green. No one really pays a premium on this. And if you have the conversation with them today, they fall into one of two camps. They fall into the camp of, well, if I get better NOI, net operating income, if the track record shows better appreciation and longer lasting value, if it shows stickiness with the tenant, then it's a more valuable asset. The second camp is basically, well, who isn't selling a green building these days? And so from a future-proofing of my asset standpoint, why would I have an energy inefficient building versus an energy and water efficient building, even if I don't believe in green? So in many ways, I think that again, the oldest game in the book here is sustainability and looking at it from a market inefficiency, resource inefficiency standpoint. And if I can improve the efficiency of my asset, I've improved the performance of that asset.
Eitan, what do you think about the risk as an impact investor?
I think in Africa, the risk is higher for impact investing. Any investment in Africa is riskier than anywhere else. But our way to deal with the risk is by building attractive products, whether housing or services or healthcare services. We provide a service that costs less to the population, and they want us to be there.
Can you give an example of one of your deals that you think does that?
For example, the housing sector, which is a large scale, we try to reduce the price to less than 50% of the existing market price. Healthcare, the same. When we build a hospital, we try to approach the sectors that have nothing in the other hospitals or health centers, and offer the population a service that doesn't exist, or reduce the price to less than half or to a third of the actual price in the market.
And
so that's
how
incredible.
How do you do that?
By working efficiently, fast, spending more time on planning, and working according to the standards of impact investment. You didn't mention gears, but they have a whole set of standards, which is very interesting, and utilizing the cooperation with local people, employment of locals, having a fully integrated local company doing the project and not coming as a foreigner and working locally.
And does doing all of this affect your returns? How do returns come out with an impact investment?
In our fund,
I know it's a broad brush question, but in general.
Returns are very good when you succeed. But basically, our business plans are based on the cash flow and not on the exit strategy. Because of the risk of the environment, of the country, of the local currency, of the changing governments and other logistic obstacles. So, and the ability of someone to come and take over, because there are no capital markets, you can't sell it on a stock exchange in Africa. There are very few stock exchanges, mainly in South Africa, which we don't consider as Africa. It's another part of the continent, independent in the continent. We deal with sub-Saharan Africa. So,
Sarah, you want to talk a bit about returns in this market, this part of the business?
Yeah, the returns at Leapfrog, we try to work as efficiently to be in the top quartile of private equity funds. That being said, we haven't had an exit, and we feel that this is going to be a long-term proposition. And it's building, a long-term relationship and new affordable products.
Why don't you talk a bit about, for people who don't know, what Leapfrog is and what your focus is?
Okay, so just by way of background, I had lunch with Andy Cooper, who, on his first day after he left Ashoka, or if you will, his first day of unemployment. And we sat and discussed a new venture, which eventually became Leapfrog. And the need, I'm going to say, to pull up slide 14. So what we looked at was who was financially excluded. And this is a chart on the rise of the middle class and even the what I call the upper-lower middle class, and how financially excluded they were to banking and any other financial services. In slide 13, we see that the whole market, slide 15, we see that the whole market is growing exponentially. And it's great enough for focus for everybody, if you will. We narrowed in on the microinsurance market, and that had to do with the next slide, 16. We have about 1.9 billion in that market, and it's not the bottom billion, but it's the billions, the 2 billion, and particularly the sixth set of the 7th billion market that we are targeted in. And 70% of those don't have access to financial services, and as you can see, that the consumption is growing very rapidly. In 17, as I actually had a background in insurance, and there was a microinsurance study done about the great need in the 100 poorest countries. We started out with some very bold ideas, and for people who never had any fund experience, we decided to raise a $100 million fund and close with $135 million. And we now have been servicing 22 million people, and 70% are women and children. And I guess you can gather the rest of the statistics from the chart. Going to the next slide, let me give you an example of a company that we invested in. So it's slide 19. It's called All Life. All Life is the only company in the world that sells life insurance policies to HIV-positive people only. It's based in South Africa, and the way they discriminate in South Africa which is 18% of the population is HIV positive, is that you can't really get a home mortgage or a business loan if you don't have life insurance. And as such, there was really no hope for people because it was so unaffordable. And what we've done is invested quite a bit of time and effort and money into a kind of a startup that had sort of a proof of concept. And we now issue policies at all kinds of levels, and some very affordably. Part of our social impact is we reach out and call them and speak to them at least once a month. And yes, they do have to, one of the requirements is for sure that they actually have to take their meds, and that they are tested, twice a year. But it's been very, very successful. And we have policies for over 30,000 people, which includes, depending on your multiplier, many, many beneficiaries. We also found that after they take out life insurance, that their blood tests, they improve 15%, even whether they're post taking meds or whether they're even in the category where their immune systems work out well. And it's been very, it's a very profitable venture so far, although we're early in this cycle. But it's certainly, we're plowing a lot of cash back into operations and new management. And we've increased it. We expect to have over 250 people employed by the end of the quarter.
Great. So when we talk about risk and return, when we had our phone conversation, one of the things that came up were deal structures. So I want to talk about whether an impact deal is structured differently as a way to deal with some of these issues. And you had some thoughts about that.
Sure. Can I pull up slide 11, please? So absolutely, I think I'm going to focus on direct investments for now. I mean, impact investments is a broad spectrum. They can go through funds, but let me just focus on direct investments. This is one of the investments that we did earlier this year in Philippines, and what this is actually a vocational training social enterprise in Philippines. It helps youth between the ages of 18 to 25 get jobs in call centers, which is a very, very good industry for the Philippines, very stable income, gives them 4 times their salaries, what they will otherwise get for unskilled labor. So it's pretty much puts these youth on a very good path. Now, if I use this as a case study and sort of, pull out sort of the key differences between a normal private equity deal and something like this one, I guess the first thing I would say is what binds all impact investments is the commonality to create positive social outcomes. I mean, that's why we're all here, right? So naturally, in any investment, the first question one should ask as an investor is, how do I align these outcomes? How do I ensure the outcomes are there? How do I entrench it in a deal structure? And how do I align the investor and the social entrepreneur? So if I use this deal as an example, so if you imagine a vocational training institute that helps at-risk youth, right? Some of the outcomes could be, how many of them graduate from vocational training? How many of them get placed in call centers? How many of them get salaries at least, in our case, 4 times higher than what they will otherwise get? How long do they stay in these jobs and are they happy? And finally, how are they using their increased income? Does it transcend to increased livelihood, increased healthcare? So these are just some of the outcomes that we want to create in this deal. And how we have that alignment is we did this through a convertible note structure. Essentially, it's like a loan, right? That converts into equity at a discount. What we did is we worked with the entrepreneur and the investors with very open dialogue to entrench these outcomes into a framework, what we call impact framework. And we entrenched the impact framework into an event of default into the note. So you as a note holder would say, if certain outcomes weren't reached, social or financial, you have the right to redeem. And that's what happens in traditional financial markets. That's how you align. So that's one key difference. The second key difference I would say is, for most of us here, we talk about motivations. We're here because we want to do good. So in the same way, many impact investors, in this case 4 of them, they didn't just come with putting money on the table. A lot of them, there were actually 12 investors for this round. We worked with the entrepreneur to screen out 4. And why do we screen out these 4? It's because each and every one investor brought in a strategic value in addition to just funding. It's never just about the money. So if you look to the left, we brought in a venture capitalist US investor based in Singapore. And he really focuses and wants to help startups. So we knew that that's adding financial discipline or to the process. The second one is an educational philanthropist. He has set up an entire trust that basically invests and gives out money to educational causes. And why we brought in this investor is because he's very good at curriculum, train the teacher, etc. Right? So making the social enterprise a lot more powerful. The last 2 were Filipino investors, and each of them brought in a particular skill set. Because this is in the Philippines, the ability to scale is a very important factor. So one of the investors has a very good relationship with Ayala Foundation, which is one of the leading Filipino families that helps invest in schools. So we thought if this does well, they can use that network to expand. So that's probably the second aspect I'll bring to this deal. So kind of in deal structure, quite similar to a traditional private equity, but really trying to incorporate that social outcome, really trying to get a little bit more than just the money, but also your networks, the expertise of investors.
Great. Dave, you want to talk about structure a bit when you think about investing in this space?
Yeah, I think that if anything, it's an ideal time and an ideal place for what I would call finance as innovation. And what we have are situations where maybe they're marginally profitable or marginally market rate. And the question and you have to think a little bit harder, and that is, how are the complete set of benefits in this transaction or in this deal aligned to the right investors. And the example that Ann just gave is ideally suited for that, and that is you've got investors that have very different agendas or very different ways that they want to quote unquote get paid. And they may not always want to get paid in monetary mechanisms or return on investment. And how do you create that trade-off so that everyone gets what they need? I'll give you a much more practical example of this, and that is if you look at the year 2000, 2001, 2002 here in the United States, I would submit that no wind deal of utility grade, 100 megawatts, 200 megawatts, would have been financeable. All right, and the day before and the day after, in 2000, 2001, 2003, you had the same ITC and PTC, the investment tax credit, production tax credit. Technology in the windmills hadn't changed, economics hadn't really changed. What fundamentally changed was the tax equity flip structure, all right, which took a marginally pencilable transaction and basically aligned the full breadth of the benefits to the appropriate investor and their characteristics. If you look at, for example, a lot of the very innovative work that's taking place today in the social impact bonds, or as they're now being called, outcomes-based securities, the art of those is not the high-level glossy discussion about the need and the benefit. The real work in creating an outcomes-based security is absolutely understanding who benefits, how they benefit, and creating a deal structure that allows you to align those benefits to the right investor category. And so in many ways, we think that the innovation capacity, an opportunity to be creative, is really strong here. But it also takes a lot more work because it isn't just a simple, pull out the template for the deal, Series A preferred, I get 1x participation preference, and, 2 board seats out of 7, blah, 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 okay? You actually have to work at understanding the cash flow, the benefits flows, and then find the appropriate entity that values that benefits flow.
And have you used that in any of the deals that you've done? Can you give an example?
Sure. If you look at any complex, I'll take 2 examples. Any complex real estate deal, there are real estate folks in here that do major $200, $300, $400 million downtown restructuring, redevelopment. You know that every single one of those deals includes a grant level, some economic development layer. If you're in the right zone, it might include tax increment financing. It might include a special tax abatement for that sector. It includes, by the way, the city, in order to let you have the 4 city blocks, wants a community theater. They also want a low-income housing slice. So now I have low income, I got CRA, I've got a community block grant, I've got grants from a foundation, and sitting in the middle of that is a big block of commercial grade debt, commercial grade equity, and the damn thing looks like 35 SPVs and a stack and lots of legal, lots of lawyers, lots of accountants. But we do that every day. We do that every day across America, and we don't think twice about it. All right. We use that same structure in our waste-to-energy projects, where you're converting farm waste or manure into energy, and almost inevitably there's a slice of a utility-grade instrument. There's almost always a slice of some sort of a climate or carbon grant. There's almost always a slice of some economic development engine, and then there's just the for-profit end of it.
Mm-hmm.
I will give another practical example of impact investing versus other type of investment. I just saw information that Africa holds 30% of the uncultivated farming land. Okay, what you as investors would try to do is get hold of the land and start farming. So impact investor would, this is what we do actually, create a agro-industrial center to support the local farmers to improve their production. Sorry. That requires a lot. You have to persuade the government to pass ownership of the land to the farmers, which is in some countries is very difficult. You have to understand what they need for local consumption. How can they become self-sufficient in their food production, and and which are the strategic aspects of the country of reducing imports and controlling their foreign currency balance. And at the end of the day, it's helping the farmers become more productive instead of making a farm and using the farmers as your employees.
Sari?
Alongside most of the investments that I've been involved in, we've actually developed a not-for-profit or a grant arm. And some of it started with the fact that our major investors are people like IFC or development banks, and they all have a certain percentage of the investment that they give as grant money. And I would say that that has been very supportive of projects that in early exploration or sometimes in doing a deeper build with a management team or training and measuring impact or new ways of measuring impact.
So picking up on that measuring impact, there's been a lot of activity in this space and coming up with consistent measures and standardized measures and rating systems and ideas that it's going to bring more capital into the impact investing space. As you all who are on the ground doing deals in this space, do you measure impact? And if so, I know, Ann, you talked about it a bit, how do you measure impact and what do you see as the value of measuring impact? Anybody want to pick that up?
We do. We measure. We use the GEARS system.
You want to describe that a bit for people who don't know?
It's a system that measures the features of social aspects, financial aspects, and environmental aspects, put them all together, and gives it a rating. It's a process that we go through when we evaluate opportunities, investment opportunities, to approve them or not. By the way, I just checked, and we had about 40% of all the investment opportunities rejected due to S&E issues. And then
Social and environmental.
Social and environmental. And then this rating system allows you to periodically check on each portfolio, each project, each activity to see if everything is working properly, and you can see the trends and change wherever it's necessary.
And how about you? Sorry.
We certainly measure impact, and part of it is thinking up front as to what the measurements would be. And next month we are coming out with a big study that we've done in microinsurance with McKinsey on this subject. So we measured both internally and in terms of the people that we service, but also how we're treating our employees and people who are involved in our efforts.
Sure. Yes, I mentioned earlier, impact investing measurement is something that's really important for the industry. And I think there's been, over the past at least 5 to 10 years, significant developments in this space. So you've heard us mentioning IRIS. IRIS is Impact Reporting Investment Standards. There's GEARS, Global Impact Investing Rating System. There's SROI in the UK, which is Social Return Investment. So there's quite a lot of these methodologies out there. And what I first start by saying is that there is no one shoe fits all. In a place like, for example, myself, we cover 15 countries in Asia. Whether you're measuring the impact of a rural school that helps women in India versus one that in China, it's very, very different. So I think most methodologies start by using the same premise. They try to standardize the taxonomy or the language and what people call indicators. And after that, they try to apply some kind of rating metric, which is either relative or absolute. So I think the key challenge for this space, for the impact assessment industry, is whether or not you can actually contextualize for the correct country, sector, and the correct business model. And on a portfolio basis, whether you can rationalize the social performance of all companies across that portfolio. I think that's a real challenge. And I think what we do at IX in Singapore is we try to also work out not just the methodology, but practically whether or not the social entrepreneur can actually deliver on that, because you may set a methodology which is so high that you're actually diluting the operational focus. And the flip side is, even if you set something that's quite high and what the social entrepreneur can do, investors might not want that level of information. So I've seen social impact reports that go from 70 pages all to a one-pager. So we take a more pragmatic view that is trying to really align what investors want in the quality of information on social metrics as what is the company willing to provide.
That's good.
Let me just add that there's one country, Bhutan, it's a small country in the Himalaya, that has a GNH, it's a Global National Happiness Criteria. And the king 30 years ago said, or 40 years ago, said that the G&H is much more important than GDP.
And there's a number of cities that are now starting to do that. In fact, I read the other day that Santa Monica is going to do it, measure its happiness. Should measure it on a day when there are not that many cars in the city. Let's talk about some more specific examples. And you had a couple other examples that you brought in of deals that you guys had done. You want to talk about one of them?
Sure. You want to link up to with innovation?
Sure.
Yeah. Okay, can I put slide 12? So one of the things that's quite exciting for this space is just, when we're talking broadly, since we're at the Milken Institute talking about innovation, is, yes, it's basically trying to think what is innovation for this space. And at least from my perspective, I think we see sort of three interesting innovations. One is interesting transaction structures and
Financial
funding.
innovation.
Yeah,
right?
funding vehicles. I think that's one bit. Another one, which I think Dave also mentioned, social impact bonds. I'm sure some of you here have been reading about it. Is financial innovation through products. And the last thing is sort of innovation generally in bringing together various stakeholders in deals, which I think is very, very important. And I forgot to mention earlier about one of the key differences is that for this space particularly, you have a whole range of stakeholders. So how do we even start combining capital efficiently between philanthropic capital and investment capital? So you see various permutations of innovation. So if I maybe start on the first one and kick the ball rolling, this is a deal that we did in India. It's an inclusive financing deal. Essentially, many of these people in India that have basically got microloans, loans below 200 US, have used those loans quite successfully to scale up their small businesses to a level that they're too rich to get microloans, but they're too poor to get traditional bank lending. So it's one way of calling these people in the missing middle. So this company, or the social enterprise in India, really focuses on that segment, giving loans anywhere from 2,000 to 20,000. Now, what's interesting for this deal is when the entrepreneur first came to us and said, can you help us raise capital? We found that they had two lead investors, but there was a pretty sizable $500,000 ticket where they couldn't really close the funding gap. So they said, can you help? And at the same time, we had a whole bunch of small investors that wanted to come in at ticket sizes anywhere from 20,000 to 100,000. Now, typically for this deal, it was very difficult for the entrepreneur to take that capital. Why? Because they'll set up as a NBFC in India, NBFC, non-banking financial company, which meant that every investor that came in, they had to do onerous reporting, they had to be registered, it was a cost. So if you pull that all together, taking 20,000 from a high net worth individual or 100,000 doesn't make a lot of economic sense. So what we did as IX, we pulled together an SPV model, which is quite common in traditional sort of deals. And we brought together 17 investors that came through the SPV structure. So what that meant was the SPV is actually a single investor. The social entrepreneur doesn't have to have to deal with reporting to 17 different people, but could just report to one SPV. At the same time, it was cost effective because they only had to register that transaction as one investor. So this is really just to give a flavor of some of the innovations that I wish that we could import from the traditional financial markets into the social space and get a little bit of that innovation across. I'll touch briefly on the second innovation and open up to my panelists here as well to share. But when we're talking about financial innovation, that's another thing that we see that's quite interesting. We see loan structures, we see stopgap losses, essentially guarantees structures where investors are coming in and saying, we will guarantee up to a certain amount of risk, such that you free up or you de-risk for other commercially minded investors to come in. The social impact bonds that Dave might mention is another product innovation that we see in the markets. We're seeing a lot of that actually in Asia, working with a lot of the developmental finance institutions to try to think of ways that we can effectively sort of get more impact. One of the things that we're doing with the healthcare fund, where we're doing a buffer fund in a way sort of to take a certain amount of buffered loss so that it makes the insurance actually cheaper so that more people can get access. So that's something that we see as well. And the last thing I want to mention is we're seeing a lot of innovation in trying to get more capital across this space. So IX, one of the things we're doing, and Sari would know this as well, is the concept of social stock exchanges. So many of us here today, whether it's funds or whether it's private equity, direct investments, are restricted really to private investors. Now we want to increase that capital flow, and how do we do that? Well, social stock exchange is one concept, right? You're trying to use a stock exchange mechanism, but to try and target two categories of investors that typically can't access this space. One, retail, two, institutionals. And why can't they currently access this space is because many of us are restricted by only dealing with professional accredited investors. Exchange opens the door to that. The other aspect is if you start speaking to institutional investors, they like the story, but the investment mandate doesn't allow them to go to the space because they don't have liquidity, uncertain exits, and the list goes on. So the exchange basically tries to open up access to capital, and that's another form of innovation.
We, on that basis, we actually formed, through NEXI, the first social stock exchange, and we did it on the stock exchange of Mauritius. So we have a fully regulated, all the listing rules have been in place for investment. And the SEM is interesting in that it clears in dollars, British pounds, and euro, and it's also recognized in the UK that pension funds can invest in it.
Yeah, Eitan, you want to say something?
Yeah, about the structure, Vital raised $350 million for investing in Africa, plus $200 million in 8 Miles. It's a sub-fund with IFC, CDC, and Africa Development Bank. The difference between the two funds is that 8 Miles will spread the risk between many in the smaller, non-controlling positions in companies on the continent, while we insist to control the business. At least if we don't have a majority, at least we have a management contract. The importance of that is that we bring our know-how, our management, we are involved, we are committed for long term. Usually we partner with local people, with local governments. We're not afraid of partnering with governments. It's possible. And the importance of that is that we can exit at the end of the day because the information is transferred, the local people, partners learn the business, especially if it's a new business. And with this $350 million, just for example, the housing project is a $2.2 billion project. Equity required is less than $200 million, but the impact that we can have on countries that are smaller or larger in Africa, from Djibouti up to Nigeria and other countries on the way, is tremendous.
Yeah. Were you going to say something?
Sure. I think innovation in this space falls into two camps. One camp is applying many of the tools and techniques that we have developed in the classic mainstream finance area and applying them to, I'll call it not necessarily a below market, but a positive outcome. And so we're watching some of the most interesting innovations taking place there in terms of return to securitization, because many of these, as been mentioned, many of these investment categories have a really interesting attribute, which is that they cash flow. And although they might not have a pure public market outcome, they might have cash flow, and therefore, especially in this period where globally we have compressed returns, people are looking for stabilized yield and cash flow, and so there are great opportunities to implement securitization or other kinds of debt-oriented stabilized cash flow structures, whether they're bonds or other things. We also see some really interesting innovations that are taking, before I get to that one, the other thing that I would say is, and this is a gross generalization, but in almost every one of the developing countries' successful product companies, and I don't care whether they're selling toilets, flashlights, or water filtration systems, if we didn't look at them from that lens, which is that they're doing good, and we looked at them purely as enterprises, most of us in this room would actually look at those companies and ask the question, why isn't there a consumer financing or a business leasing third-party entity that rides alongside of that? Because in almost every one of these cases, whether, again, it's flashlights, whether it's a small panel solar, or whether it's a $30,000 water filtration system. Almost 100% of their sales are actually timed, debt-oriented, credit-oriented sales. And one of the gross market inefficiencies in these markets is that no one, including the entrepreneur, rarely sees their company as a consumer financing or a business financing entity. They see them as a product company. And so the very same thing that a BMW or a GE would have seen 30 years ago, that's a wave that's going to go through these companies, especially as they start to get to 20, 30, 40, 50, $100 million of revenue. Some of the other innovative spaces that we're watching, and this would now be in the second camp of real innovate, the next wave of innovation. We're seeing environmental services coming about again. We saw the debacle with carbon, but we're watching some smaller markets like water credits, biodiversity credits, wetlands mitigation credits go through their next generation of iteration. And some of these markets are billion-dollar markets. And so we're watching the environmental services markets start to take their next wave of maturity. We're watching the social impact bonds. I think that over the last 2-3 years, we've had a mania across here, certainly in the United States, around social impact bonds, and a lot of burned sort of projects or projects that never quite made it. And that's because my observation is that most of them didn't employ financial discipline to that. They stayed at the very high buzzy level. And we're watching the next wave of instruments now called outcomes-based securities beginning to actually apply a spreadsheet to these entities and beginning to negotiate benefits models. So really exciting. I'm actually much more optimistic about this category than I was a year ago. And then the last one is insurance products, and of which Seri and Leapfrog are pioneers in that. But we just see huge categories of insurance innovation that's going to be applied to this sector.
Can you talk a bit about a domestic example? We've been doing a lot of talking about the developing world, but you do work in the U.S. too. So give us an example of an impact deal.
Sure, I think I've already given several. We have a green real estate portfolio on our platform, and that's Fund 1 was 185 million. Fund 2 is in the process of being. We just did a first couple of closes on that. That's targeted at basically market rate returns in real estate, sort of classic value add. We have a portfolio that focuses in on waste to energy, which is specifically a couple of very market inefficient areas. A lot of attention over the last decade has been paid to big solar and big wind, but the whole area of small-scale waste-to-energy facilities, and especially exacerbated by the banking crunch that we've had in the last few years. You can't finance a $3 to $25 million energy facility, but they have this wonderful attribute, which is that they cash flow on 15-year, sort of locked-in basis. And so we tap into that marketplace and try to dominate the market of manures and farm and agricultural waste and food processing waste to energy and solids. So we're always kind of trying to pick off the next opportunity that sort of goes unappealing or overlooked.
Let me see if anybody out here has any questions. And do we have a lavalier? Hey, can somebody bring that up? Or pass the mic over to here, because we need you to make sure that you say it into the mic because it's being taped. Thanks.
Hello, can you hear me all right?
Yeah.
First of all, I want to thank the panel. And the thing that I wasn't hearing, maybe because we didn't land on it, I heard about the homeless, I heard about medical care, I heard about the need for affordable housing. But I'm wondering, in any of these major impact deals, do the arts play a factor in any of this? Is there a concern among the communities that you're doing these investments with that there's an opportunity for the community, the people, to portray the human condition through the expression of the arts? Because I think that's very important. It always seems to be left out of these conversations.
We set up in the communities, in the community centers in each one of the villages or urban developments, we have a fund who supports local artists to teach their own people their own art. We don't bring foreign artists to teach foreign types of art. This can be ceramics, can be painting, literature, dancing, music. And the support we give the artists is to produce whatever they do. And their commitment is to come twice a week at least to the community centers and teach the children that come over, usually it's street kids or women that come over, just open doors and teach them their art.
I'm very glad to hear that. Thank you.
And there are also examples of funds that fund media, public media, film, things like that that we'll use to support it. So there are examples of those. Dave and
If I look at our real estate team, they fundamentally believe that the value of the real estate and the impact that they can have is both economic as well as environmental, but it's also in community vibrancy. And so if you can increase the walk score, the vibrancy, the crowds, the walking about your building selfishly, you're creating a greater value in the real estate. But part of that means identifying and rooting with the community. And so if you look at almost every one of the projects, they bring about the local art community, they bring about the local food community, and use that as basically engagement, not only contribution, but ways of engaging the community. And again, anchoring that building or that project development as a resource for the community. And again, selfishly, from a long-term standpoint, it creates greater value because you just plain old have more people around.
Well, I'm glad that you know that.
Sure. And I'm just going to answer, thank you for asking that question. I think it highlights something I want to say, at least from my part of the world, Asia, a lot of countries, India, Bangladesh, Thailand, Cambodia, a lot of the entrepreneurs that we work with have artisanal product. I mean, they're essentially trying to preserve their skill and trying to make an income out of it. So there is absolutely an issue there. But more important than that, you mentioned about the human condition. And I think this is why we focus in the sectors that we do, because by teaching them to preserve their art and their culture relates to human dignity. And many of these people at the bottom of the pyramid, to them it's really important that they retain some of the community arts and their culture because that is their dignity, which is priceless.
why don't we do one back there and then we'll move it over here.
Hi, thank you. I really kind of quick 3 points. Maybe each panelist could pick just one. But don't all businesses have social impact? And how do you then differentiate yourself from a normal venture capital investment where they can spin it and they can say, yes, we're doing good in one way or another? The second is I'm interested in this intersection between what you're doing and philanthropy. And how that works, since so much money, trillions of dollars a year go into philanthropy. And then the final point, the sub-point of that is tax policy. Do you operate as fully taxed public corporations? Can you get tax benefits? Or should there be created a kind of hybrid tax structure for what you're doing? Thank you.
Who wants to pick any one of those?
We'll answer the tax. Just every entity is a local-based entity paying full tax in the country it's based in. That's part of the participation in the economy. We don't want to be foreign investors and not pay local tax.
I'll tackle the first question, I think, which is something that most of us here, I think, will be asked at some stage. At least from my perspective, I think they're very, very good questions. How do I differentiate a normal PE deal versus a social one? I mean, I tend to think that one of the key differences, there are two key differences from my point of view. The first one is intentionality. So I deal with a lot of funds, I speak to funds every day. So many of the funds in Asia come to me and say, hey, we're an impact fund. But when I look at them, I say, why are you an impact fund? They say, oh, because we're operating in Cambodia or Laos. Just by the fact that they're operating in these countries, you're absolutely right. Where they are economically and socially, all investments will have a social outcome. Right? But if the intentionality is not part of the investor nor the business model, as the company scales and get to some stage that, a Blackstone's or KKR or CVC will look at them, there is a chance that when they exit out of that investment, all the social good that has been built up is actually diluted. So I think one of the key differentiating factors is that intentionality to create that positive outcome, whatever that may be. Okay. Second aspect of that is a case of practicality, capital raising, right? So I have two companies that came to me 2 weeks ago. One is a solar company in China that produces very low-cost solar panels, extremely profitable. And I have another one that does very small rural distribution of solar solar panels. Now, the first one doesn't need me. They don't need us, right? They have access to all the PE people. They can list on and they can IPO, right? So I think from that point of view, I tend to take the second differentiating factor is that I'm trying to help the companies that can't get access to traditional funders. So that's the other key difference. Sorry.
I was just going to say,
Sure.
microfinance is one of those areas where Green Bank.
Can you
Yes.
use the mic, please, because it won't pick up on the recorder.
Microfinance was one of those areas where what Grameen Bank started and would be much considered impact investing, but it morphed into something very different to the point where in India, for example, the rural leaders and the governmental provincial leaders were telling people not to pay back because the interest rates were being charged at 120% a year, et cetera. And so they were creating these highly, highly predatory organizations which were riding off the back of Grameen Bank. And it's that intersection that how you guard against that.
Sure. It's a very, sorry.
Go ahead.
Go ahead.
I'll just spend 1 minute on this. The whole microfinance saga in India warrants a separate discussion, but I'm going to spend 30 seconds on it. So if I use a case in point, it's SKS Microfinance, listed on the Bombay Stock Exchange, November 2011, 16 times oversubscribed, 1.6 billion valuation, raised $350 million. And this is for organizations that lends out loans less than 200, right? So very extremely successful commercial deal, not so successful social deal, when 6 months after they listed, 25 people committed suicide, of which 12 of them were SKS borrowers. Okay, so you're absolutely right. So how do we get this difference? And I think what I'm trying to say is that capital can be the wrong type of capital, and that's my earlier point that we alluded to. That having that mission is really, really key. So how it relates to how I answered your question is, if that intentionality to do good wasn't there in the first place, this is where you're going to get that mission drift. So that's the difference between, so in structure, they could look almost identical. An IPO for SKS, an IPO for any other company could look similar. But because the values or the fact that you're ultimately trying to benefit people at the base of the pyramid by giving very small loans was somehow detracted from, that mission protection is what went wrong in that deal. And I think that's what shows the difference between a social deal and a traditional private equity one. You need to have that mission protection.
Dave, were you going to add something?
Yeah, I think that one of the things that differentiates this field and it has a material value is the word authenticity and trust. And I realize that both those words in the finance industry sometimes in the recent past have sort of questionable authenticity in itself. But if you listen to a lot of what has been said underneath the surface here, a lot of these deals are multi-stakeholder. A lot of these deals involve getting the support of whether it's government, whether it's regulators, whether it's an entire different set of investors, bringing together very complex structures. And that's a fabric of trust, because it's very easy on a spreadsheet or on a piece of paper to actually pencil out many of these deals. But as you all know, it's not about envisioning the deal, it's actually getting it done. And for these companies, the authenticity that you're really trying to do the right thing actually materially gets you the support of regulators, of government, of foundations, and that's not to be trivialized. So one of my favorite examples is Lime Timber here in the U.S. Lime invests and manages about $500 million, and they're one of the preeminent conservation forestry TIMO investors in this country, upper decile performance in their category. And if they were to lecture this room today, you would say, well, geez, what's so hard about what you do? Because in fact, your secret sauce in your rule book is actually very clear, all right? But try to get a 20,000 acre transaction in the state of Maine from a family that owns the property for 200 years, knowing full well that you may not be paying top dollar, but you're guaranteeing that that land is going to go into a very productive use, that the next 1,000 acres of that land is going to go into some sort of a community redevelopment upon which the town will pay for it, and then the state of Maine is going to set aside in their conservation budget a certain amount of their budget for conservation easements. That isn't 3 cups of tea. That's 200 cups of tea, and 2 years in the making. but a very legitimately profitable deal, but it means also sharing the profit and the gains and the benefits across a broad spectrum. That is the instantiation of authenticity, because they get to do it again, and it's the instantiation of the monetization of trust. Because you can't do it. 3 guys in Wall Street can dream up this deal, but it can't get done. So I think that's one of the major differences, and we see that across the fund managers that we respect. We see that across the asset classes that they're buying. We see that at the transactional level.
And I want to pick up on the philanthropy question, because it is a good question. I mean, there's a role for philanthropy. Can you pull up slide 5? Now, philanthropy can write checks for grants. You put the money out, it's done. It's a great role. They're good at kind of, making the case, the early stage, building the infrastructure. And then there's a role for philanthropy in the deals. We've talked about it today. They can come in, they can put a loan loss reserve up, so that you can then get loans out that would not be made otherwise. So I think none of this is an either or proposition. And this is just kind of a very crude diagram that shows, you've got profit maximizers who are aiming for financial return and not worrying about the rest of it. You've got philanthropists who are focusing on the social and environmental impact and not worrying about the financial return, because the financial return of a grant is 0 or negative. And then this group is kind of operating in that upper right quadrant and thinking about, how do you pull a little bit from products, from each side, and putting the tools together to work that through. So we have now reached conclusion, and I apologize for those of you who don't have questions, but I encourage you to come talk to the panelists. And I want to thank all of our panelists and thank you for being engaged.